Why is gold suddenly sparkling again? We've just seen an ongoing 4-day rally in gold prices, which has jumped to over $2,690 an ounce, its highest point in a month, despite headwinds from a strong bond market and a dollar that continues to defy gravity. Now, you might be sitting there thinking, is this really just about gold being the old faithful, safe haven? Or could it be a sign that we're on the verge of another financial mess caused by unsound economic leadership? Yes, folks, we're not just talking about glittery rocks here. This rally in gold is like a litmus test of what's fundamentally wrong with the global economy and reflects how investors are shifting their bets, not because they're excited about the future, but because they're terrified of it. It's the classic risk-off move, where everyone runs to safe assets because they're losing faith in the way the world's economic dynamics are shaking out. So let's break this down, point by point, and crack open what's really driving traders into the arms of gold, again. When traders pile into gold like this, it's not a vote of confidence. Instead, it's like someone shouting, "Fire," in a crowded theater, and we're all watching people make a mad dash for the exit. Why the panic? Ladies and gentlemen, the answer is as old as modern economics itself: uncertainty. Uncertainty over what? Well, let's start with the Federal Reserve. Following recent signs of economic resilience, an exceptionally strong jobs report, for instance, market participants are now in real doubt about whether the Fed will cut rates. In fact, some economists have backtracked on earlier predictions for additional rate cuts, signaling that borrowing could remain more expensive for longer than anticipated. Now, keep in mind, we're already supposed to have transitioned out of a rate-hiking environment. The interest rate hammer was slammed down throughout 2022 and early 2023 to curb inflation. They told us, higher rates, and inflation will settle down. But now, they're dragging their feet when it comes to lowering those same rates, even when the foundation of the current uncertainty is this very ambiguity about rate trajectories. Why does this matter? Higher borrowing costs don't just dry up easy credit, it's a wrecking ball for the broader economy. And here's the catch: while rising rates are usually a bad omen for non-yielding assets like gold, the lingering uncertainty is propping up the metal due to its safe haven appeal. Make no mistake, this isn't a sign of market optimism, it's anxiety screaming through the price charts. Okay, so we have uncertainty. But where does it come from, exactly? As the latest US jobs report showed, the labor market isn't giving up just yet. What we saw was not only stability, it was exceptional resilience. Economists were expecting signs of strain, some cooling off, but no. The US economy is flexing its muscles, which has led to speculation that the Fed might hold rates high longer than expected. Here's where the narrative really starts to break down: in a system where the cost of borrowing remains elevated, everything else in the economy feels the pressure: homeowners, businesses, and, yes, even governments that rely on debt. In fact, let's throw in some fresh data here to underscore the point. In 2024, mortgage rates in the US climbed toward 8%, levels unseen since the early 2000s. This is absolutely brutal for first-time home buyers and businesses alike. Meanwhile, corporate debt refinancing, projected to hit nearly $1.2 trillion across Western economies in 2025, will come at a much higher premium compared to the previous debt cycle. We're talking about a domino effect waiting to happen as companies face much higher financing costs, with job losses, stagnation, and recession becoming all the more likely. But, here's the real kicker: unemployment may still rise, but the inflationary specter? It's not going away anytime soon. The idea was that high rates would break inflation's back. Did that happen? Not really. We're still staring down the barrel of persistent inflationary pressure across key sectors like energy, food, and housing. Let's put this into perspective. The reported U.S. Consumer Price Index, CPI, for November 2024 showed inflation still hovering at 4.8%, a far cry from the 2% target the Fed insists it can achieve over time. So what's really going on here? Well, this is where the real failure of economic leadership strikes: the Fed's back and forth, flip-flopping between hawkish rate hikes and dovish insincerity about inflation control is leaving the markets with no clear narrative. In the absence of clarity, investors jump to gold. It's the safe bet in the middle of a Fed-generated policy mess. Now, if there's one thing the market hates more than monetary policy uncertainty, it's political uncertainty. And boy, do we have plenty of it. With Donald Trump making his roaring re-entry into the political scene, this point can't be understated. Let's face it, Trump is a walking disruptor for the markets. His mere presence makes global financial players jittery, and his promises of radical fiscal and trade policies have investors rethinking their positions. The expectation here is clear: more chaos, more sanction threats, more geopolitical tension. Meanwhile, the ongoing fears about US-China relations and disruptions in global trade flows haven't magically disappeared since Trump left office. His war of tariffs, protectionism, and erratic trade stances weaken key linkages in global supply chains, effects we're still reeling from as we head into 2025. Investors know this, and even though it's early in the race, the writing's on the wall. More Trump means a lot more market volatility. Now, I can already hear some professional analysts in the back muttering, but isn't this just a refuge? Aren't traders just playing it safe for the time being? True, gold isn't a perfect metric of upcoming doom, and it's long been positioned as a hedge, but the question we have to ask ourselves today is this: how much of this demand is driven by real underlying economic risk versus simply normal market cycles? The flight to gold usually happens when confidence in other assets crumbles. Look at how equities have been yo-yoing. Last week alone, traders significantly cut their positions in stocks, showing just how unwilling they are to buy into the current environment. Tech stocks, which had been soaring to new highs in 2023, started faltering as earnings showed cracks under pressure from high borrowing costs. Higher bond yields and a strengthening dollar are typically negative for gold, yet here we are, gold is rallying anyway. This is a case of contradictory market forces, which usually wouldn't occur if the broader economic picture were stable. The paradox, strong bonds and a strong dollar supporting gold, starts to make sense only when you realize that investors are hedging against systemic risk. This tells us more about the fragility of the system than anything else, as investors stockpile gold in anticipation of something worse coming around the corner. It might seem like we're just picking pieces apart here, but let's zoom out for a second. Isn't it clear that something's fundamentally dysfunctional? We've got persistently high inflation, yet robust job numbers. We've got higher borrowing costs, yet workers are still fighting for wage gains that even remotely keep up with inflation rates. Businesses, meanwhile, are caught in a double bind, as inflation eats into profitability, and expensive credit burdens further limit investment and growth. And let's not forget supply chain disruptions still swirling under the surface. If you thought those problems were solved after 2021-2022's pandemic-related bottlenecks, think again. Key industrial inputs, microchips, and energy markets are still volatile, especially with geopolitical tensions cutting off certain critical trade flows. So, in conclusion, this 4-day rally in gold is much more than just people looking for a safer investment. It's a loud, glaring warning sign that our global economic system is still dangerously fragile, while the folks running the show seem more interested in giving lip service to problems instead of solving them. As market participants prepare for more volatility, whether from the Fed's policy roller coaster or the political circus heating up ahead of another contentious election, they are defaulting to gold. But remember, gold doesn't fix the system, gold's rise is telling us the system is sick. Prepare for rough waters ahead, and if you're still thinking that this latest gold rally is a one-off, think again. It's an indicator that the trust in traditional markets continues to erode, and unless these deeper structural issues are addressed swiftly and effectively, we might find that gold was just the early warning flare.